Hey everybody, I get this question all the time. Are annuities safe? I know that word annuity has a stigma to a lot of people. So we're going to do a whole series on what annuities are and all the different types of annuities out there. So let's jump into, are annuities safe? So we're going to start with, what is an annuity? What is the essence of an annuity? And all this is a contract. You put money in and you're buying a contract, no different than a CD or a bond. Believe it or not, a CD and a bond have the same structure. It is a contract. You're putting money in, you have a written agreement on what they will provide with guarantees. Now, in an annuities case, that money goes into the contract, and then you're going to get one of three different types of contracts out there. Okay, you got the immediate annuity world. Okay, this is where you're putting money in, that cash value of that annuity goes to the insurance company, and in return, they're agreeing to pay you a payment for the rest of your life. Okay, then the next option is variable. Okay, you're putting money in, the insurance company is just housing it for you, and you're paying a fee for some benefits from this insurance company, but they're allowing you to invest it in the stock market. They're not making the decisions on the investing. You and an advisor would be making those decisions. Okay, so they're not really holding on to your money. They're just housing it so you can invest it in the stock market. And then the other contract out there is the fixed and fixed index. This is the deferred contracts. Now, there's some gray area because there's some variations somewhere between these variable contracts and these fixed and fixed index contracts. But for the most part, this is where we need to understand things. The contract lays out the terms for which the insurance company will provide benefits. You're handing them money. In fixed and fixed index case, they get to go invest however they want, but they're agreeing how to pay you interest, and they are agreeing on any income benefits or anything else that they may be providing. Okay, so the contract is very important. So what's next? Well, what do they do with this money? We keep giving them money. So let's talk about what banks do. We all seem to be very comfortable with banks and bank CDs and things like that. So banks, we give them our money, right? Checking account, savings account, CDs, we give them our money. Well, that money's not just sitting in the bank vault. That's not what happens there. They lend it out on credit cards and mortgages and auto loans and all these shorter term loans, okay? So they're investing money. That's how they're utilizing your money. They're using everybody else's money to make money, and they are hoping to pay you back less than they made, right? If an auto loan is 5%, then the CDs are only 3 and 4%. They're trying to make money. It's pretty obvious. We've always been comfortable with that. We've always given the banks our money, okay? Well, an insurance company is just a better mousetrap. Insurance companies receive your money through annuities, life insurance, health, home, auto, even business insurances. Think about all the money you've paid to insurance throughout your entire life. We're required to carry lots of different types of insurances. If you want to drive a car, you don't have a choice. If you want to have a mortgage on your house, you don't have a choice. You have to pay these insurance companies. So they actually just have a much better mousetrap to get your money. They're getting your money all the time. These are some of the biggest portfolios in the world, okay? So they have lots of your money. They're doing the same thing. They're investing your money and hoping to pay you back less than they made. So there's a lot of restrictions on what they're allowed to do and not allowed to do, just as the banks. The banks can't just go throw your money in the stock market, nor can the insurance companies. They're regulated very similarly, okay? So let's look at this. We have lots of guarantees with insurance companies. The first part is they're heavily regulated on how they're allowed to invest their money, okay? They got regulated out of the stock market, I believe, in 1905. It was right at the turn of the 1900th century. Believe it or not, because they could control the entire market. They had so much money, they could just hit a button and buy everything. And then they could sell everything and then buy it. They could play around with it all day long. And they just had to put a stop to that, the abuse that could go on. So then the other part of this is the model audit rule. Every year they have to prove they have the cash on hand for the risk in their portfolio. Meaning, if they are a homeowner's insurance company in Tornado Alley, then they have to have more cash reserves. So we have to look at that every single year, and they have to prove they've got the money. Okay, so that's a good thing. The solvency issue is solved right there. Then there's state agreements to do business. Every single state that an insurance company does business in has an agreement that they have to sign that reinsures all the business. Meaning, if Allstate wants to do business in Arizona, then they have to guarantee State Farm and Farmers and all the other insurance companies of like kind. Okay, so a homeowner's insurance company is reinsuring the other homeowner's insurance companies. And every state has this agreement, and they're almost all identical. So if anybody has a new product they want to roll out, they have to go get every single state's approval on that product to go out there and be sold in their state. Okay. Then there's the state guarantees. Every time they sell a policy in a state, whether it's a homeowner's policy, an annuity, or anything in between, they have to put a penny into the jar. Okay, so the state insurance department maintains money that the insurance companies have all donated to a common cause, which is guaranteeing the business. Okay, so they pretty much mirror FDIC insurance in virtually every state. So looking at this, the death benefit on life insurance is $300,000, but the cash surrender on that would be $100,000. When you look at annuity benefits, they're looking at over $300,000. So we look at all these different things, and we've got to take into account that really we're starting to look at this as safe gets. The regulations and the backups are very similar to banks. Okay, so we also have the too big to fail, right? If the biggest bank in the United States falls apart and goes under, well, FDIC is probably going to have to guarantee all that money. So the feds are going to have to go in there and just prop that bank up. And the same thing happens in the insurance industry. AIG faltered when 2008 happened because they were doing most of the mortgage insurance policies out there. The rest of their business was great. All these other insurance companies were, we'll take the business, I want this part of the business, I want this part of the business. But one part of AIG fell apart, and it had not only every state in the United States guarantees going, oh boy, here we go. It also had some international implications. And so the federal government said, look, this is just too much of a mess for every state to deal with and global issues. So all of a sudden they jumped in and decided to prop them up and get them going again. So understand that when we talk about safe get, we're talking about world currencies falling apart before you're losing money in an annuity. Okay, so guns and gold in your bomb shelter with farmland that you can defend, about the only other thing that we have to take into consideration, right? So we can't go down those wormholes. We're not going to enjoy the rest of our life if we fear that the end is coming soon. If it is, well, then go have fun and enjoy yourself, right? So understand, just as banks are as safe gets, the annuity world is as safe gets. And if you get down to the nitty-gritty details, insurance companies through history have actually been safer than banks. But in modern days, with FDIC insurance, they're relatively the same risk category, which is virtually zero. You can say treasuries are safer, but I'm going to say that's not historically true. The currency going to zero is going to make both these go to zero, and you're back to your guns and gold in your shelter. All right, so let us know if we can help out in any way. Always happy to discuss any of these topics further. If you want to meet with me for any reason, give us a call, shoot us an email. I'm always happy to meet with anybody and talk about anything. If you have questions, shoot us an email, make comments below, like the video, share the video, subscribe, do what you got to do, and we will see you next week. Thanks again.